Section 1. The Structural Autopsy of a Titan. Lehman Brothers did not collapse because the housing market dipped. Many institutions faced that same headwind and survived. Lehman's failure was not an event of circumstance, but one of structure. It imploded because its immense leverage acted as a powerful amplifier, turning a manageable market shock into a catastrophic, system-shattering event. The common narrative focuses on the housing crisis as the cause. That is a surface-level explanation that misses the deeper lesson for strategic thinkers. The real story is about how a titan of finance was built on a foundation that lacked the capacity to absorb any significant impact. It was a crisis of leverage without adequate shock absorption. This is a structural autopsy. We are not here to recount the dramatic final days or the personalities involved. Instead, we will dissect the specific financial architecture that guaranteed its demise long before the first subprime mortgage defaulted. The goal is to move beyond the headlines and understand the mechanics of fragility. By examining the core vulnerabilities within Lehman's balance sheet and risk models, we can extract a timeless framework for assessing stability. This analysis is designed for professionals and entrepreneurs who understand resilience is engineered through deliberate, disciplined risk management. Today, we will break down the exact risk signals Lehman's leadership ignored. More importantly, we will show you how to identify and avoid the same structural mistakes in your own business or personal financial strategy. We will be using a specific analytical model to guide our investigation, the leverage fragility ratio. This framework cuts through the noise to focus on three critical dimensions of institutional stability. It reveals how overextension in one area can create a cascade of failures across an entire system, a lesson that is as relevant today as it was in the fall of 2008. We will evaluate this historic collapse across three distinct structural dimensions: asset to equity overextension, liquidity, buffer, insufficiency, risk model, overconfidence. By the end of this breakdown, you will understand precisely why Lehman failed and have a practical toolkit to measure and reinforce your own resilience against unexpected shocks. It is a masterclass in how leverage, when mismanaged, accelerates both growth and collapse with equal unforgiving force. The first measure within the leverage fragility ratio is asset to equity overextension, most commonly tracked through the debt to equity ratio or its close cousin, the leverage ratio. This dimension measures how much a company is relying on borrowed money versus its own capital to finance its assets. For Lehman Brothers, this ratio was pushed to an extreme. As we established, by 2007, the firm was operating with a leverage ratio of over 30-1. With a 30-1 leverage ratio, a mere 3.3% decline in the value of its total assets would be enough to wipe out its entire equity base. Once equity is gone, a firm is insolvent. This is the critical point that was systematically underestimated. The risk was not that Lehman's assets would go to zero. The risk was that they would dip by a small, entirely plausible margin. The second dimension of the leverage fragility ratio is liquidity buffer insufficiency. This is measured by looking at the proportion of a company's assets that are liquid relative to its short-term obligations. A company can be solvent, with assets technically worth more than its liabilities, but still fail if it cannot meet its immediate cash needs. This insufficiency was dangerously compounded by the firm's reliance on short-term funding, using the overnight repo market. This meant it had to roll over billions of dollars in loans every single day. As soon as doubts about the value of Lehman's real estate assets began to surface, lenders became hesitant, choking off the firm's daily supply of cash. Lehman needed cash to meet its daily obligations, but its cash was trapped in assets it could not sell. It was trapped. The final dimension of the leverage fragility ratio is risk exposure concentration. This measures the degree to which a company's fate is tied to a single market, asset class, or economic outcome. By the mid-2000s, the firm had transformed itself from a relatively diversified investment bank into a proxy for the US real estate market. Its leadership made a conscious strategic decision to go all in on property and mortgage-related assets. This concentration was rationalized by flawed risk models that suggested a nationwide decline in home prices was a statistical impossibility. What early signal do you think they ignored? Let us know in the comments. The firm had stacked 3 layers of risk on top of one another, creating a structure that was not just fragile, but predestined to shatter at the first sign of a serious headwind from its one chosen market. The structural failures of Lehman Brothers are not just a distant corporate history lesson. They provide a powerful and directly applicable framework for assessing risk. To make this practical, we can create a simple metric, the personal leverage ratio. Calculate it by taking your total debts, mortgage, car loans, credit cards, and dividing that figure by your total liquid assets. A high ratio indicates that a sudden loss of income or an unexpected expense could quickly escalate into a full-blown financial crisis. The core question is the same. How much of a shock can your system absorb before it breaks? We can build a 3-step tactical shield to systematically reduce fragility and increase resilience. First, reduce high-interest non-productive leverage. This is the most direct way to address asset-to-equity overextension on a personal level. Second, build a 12-month liquidity cushion. This directly counters the risk of liquidity buffer insufficiency. Third, avoid stacking correlated risk layers. This addresses the danger of risk exposure concentration. The collapse of Lehman Brothers was not a mystery to be solved. It was a mathematical certainty waiting for a catalyst. The stabilizing keys to avoiding this fate are clear and timeless. First, prioritize liquidity above all else. Second, use leverage cautiously. Finally, actively protect your downside. Resilience is not about predicting the future. It is about building a structure that can withstand it. In the next corporate risk autopsy, we will examine the decades-long decline of Sears and introduce the structural decay index, a model for understanding how large organizations lose relevance and competitive edge over time.